Good afternoon, everybody, and welcome to the Middle Class Investor. Today is October 4th, about 5:40 p.m. And, Thinkorswim has finally taken away my profit charts. So I no longer can use profit charts. And I had mentioned that to you about a month or so ago, and they have finally taken it away. Let's zoom in on the market here. We had a pretty volatile week, as most of you know. Tell you what, let me do a little bit better job than that. Let's zoom in. Sorry, I can't get this. Always seem to have a little bit of trouble with this thing. I need to look for a different one. But anyway, this is the current week right here. This week right here, you can see it's pretty volatile. I mean, we opened the week at this higher portion of the candle right here, and then the market ran all the way down to here. Kind of touched this. This is a 55-week exponential moving average. You can see right here. Touched it, and that's kind of been holding. That's just a coincidence. I've had that on there forever. But that 55-week moving average has kind of been holding. It went right down to it and rallied back up and closed lower for the week, just slightly lower right in here. And but having said that, there's a couple things to notice here. I thought initially, wow, this is probably going to be, the sell-off or whatever, that I've kind of been not hoping for, but just kind of planning on. But then, as I looked at the market, I noticed one of the things I noticed is, first of all, we made a high here, so this is a high. This is real important that you kind of you kind of analyze this with an open mind. But what we could have going on here is some sort of ending diagonal, where this is, wave 1, this is wave 2, this is wave 3, this is wave 4. Now 4 could be, this could be like a 1, 2, or this could be, some sort of triangle kind of working out here, where you kind of go like this, and then a little slightly higher, a lower high, and then a higher low, where you get like an A, B, C, D, E, and then 5 and higher prices. So it could be that. It's really hard to say at this point. You just kind of gotta just be on your toes, so to speak. But one of the things I always talk about, and I know the people that come in here regularly know that I talk about this, but just the question of how much more upside is there, if you're still in, so as opposed to the downside. And the answer to that is, well, it depends. So it depends on, let's zoom out a little bit. Let me get a little bit more room over here. So, if this is now the only way this could be an ending diagonal is if this is some sort of complex wave 4, which I don't think really happens in an ending diagonal very often. So that would be unusual. But usually, if this is 3 and this is the first wave pullback, what you can do to kind of estimate the high is you can kind of go from high to low. Now, there's no guarantee this will happen. I'm just showing you. This is kind of a tool you can use. And usually, once you break out of that, you can kind of count on 200%. So, not count on, but I mean somewhere between this 1618 and this 200%. So, somewhere between 3166 and 3250. So that's pretty significant from here where we're at. We're not even at 3,000 right now. So you're talking about potentially another 250 points on the S&P 500. So that's significant. I will tell you though that the internals are not so great right now in the market, which really lends itself more to this is just a top with a very deep retrace. Now, if I zoom in on this, I'm going to zoom in. I'm going to go to like a 15-minute chart. Let me not do a 15. Let's see if I can do a 30. Well, let me go back to. Let me look at a 4-hour. One of the things I wanted to point out, and it's harder to see now because the market has rallied back into this gap. But right in here, right in this area, whoops. I don't want that showing up right there. Okay, right in here, notice there's a gap in here, and there's also a gap here. Just pretend like this is not here for the time being. So what you've got is kind of an island reversal. This whole pattern right here is part of an island reversal. An island reversal is where you have a gap up into some high, and then a gap down and lower prices, leaving these huge gaps on the chart. Usually, it's just a candle formation. So you might have a candle like this, and then a gap, okay, like this, and then maybe a candle like this with maybe a tail on it, and then another candle like this, and then a gap down. So this formation is called an island reversal. So you can see that that's what we have here. It's just it's just on a daily chart or a 4-hour chart. It's just on a larger time frame chart, or not a daily. I mean, it's on a daily chart too. Like if we go to a daily, you can see it here. Well, again, it's a little harder to see because you have this price action here. But let me zoom in here, and you can see there's a gap right here, and there's a gap right here. So you have this huge island reversal, and that's usually pretty bearish. But we do have a very deep retracement of this move down. So you basically have a situation where we fail to make new highs. You've got a move down, which doesn't look like anything really. It doesn't look like an ABC or 1, 2, 3 or whatever. But this could be some sort of 1, 2, 3, and then this is 4. Now, if that's the case, next week, next Monday or Tuesday, it should reverse. Maybe Monday we don't have much, kind of a nothing day, just a range day where it kind of goes up, goes down, doesn't really do anything. And then Tuesday it would need to start coming down. So if this is a 4, so anyway, that's just a little background information on kind of that pattern that shows up in the excuse me, had to close my door. Didn't want the dog to come in. Anyway, so that's kind of what I'm seeing or what I'm looking at on the S&P 500. And we are on the S&P 500. This is the SPX, which is the index. If this were the futures, you wouldn't see these gaps at all. So then the question is where's the next stopping point? Well, I mean, if there's going to be a new high, we can go ahead and put some stuff on here since this chart is so barren. if there's going to be a new high, it should slow down right in this area. If there's going to be a new low, it should come down into this area right in here. So we'll see next week. I don't think we'll get a new high next week, but if we're going to get a new low, we should get it next week. In fact, if we're going to get a new high, this is probably going to come down first and then rally back up, and then come down and then rally back up. So, we could be looking at several more weeks if we're going to get a new high. Anyway, I guess that's enough of the S&P 500. The point is, we had a pretty volatile week, which is not. I mean, usually when you get a pickup in volatility, it doesn't usually mean more upside. It usually means more downside. So I would expect to, at a minimum, retest this low right here, probably next week sometime. At a minimum, we're going to retest this low. So these kinds of moves, are not for the faint of heart. So just be careful, and it's your money. You got to do what you got to do, but be careful. All right, so let's look at, what do we want to look at? Let's look at, I don't have the same stuff over here that I normally do, so let's look at oil. Oil looks like it's trying to make its way down here. It's a very messy pattern. I mean, could be that we're forming a base here and we're going to get some higher prices, or right in the middle of this range. But if the sideways pattern is going to hold up, this is going to have to make its way lower. So we'll just monitor that and comment on it in the future. All right. In my list of stocks over here, I don't really have the foreign countries, so I'm not going to really talk about those today. Let's just skip over to gold while we're on commodities. And let's talk about where we were kind of before. We talked about this 1.27 area is pretty common. Somewhere between this 100 and 1.27 is a pretty common reversal area. And we see that reversal taking place here. There's a lot of stuff on the chart. I may need to kind of move some of the, maybe I'll just move this box. We already know that was an area that we had talked about. I kind of drew this before and it sort of played out like that, but not really. So I'll probably go ahead and take that away. But I think the message here on gold is that the B wave of this bear market rally is potentially in the rearview mirror, and I wouldn't look for gold to go any higher in the near term. So just to recap what we're expecting to see here, you had this big bull market run up that ended in 2011, which is a long time ago, and then you got this huge kind of let me see if I can kind of shrink it. Well, that's about it. That's all I'm going to get out of it. So you got this huge kind of bull market rally, or this kind of A, B, and then we're kind of expecting C to start happening. I'm going to take some of this stuff away. It's just not useful anymore. And for some reason, it's not going away. There we go. Push the right button and it might. I wasn't worried about all this housekeeping before because we had the profit charts that we were using. But anyway, just to recap, we have this big, huge run up the bull market, and then we got this kind of a bear market pullback, kind of an ABC pullback, and we're expecting this ABC pullback to take us into this previous fourth wave low. So this was wave 4, this was wave 5, going up into the end of the bear market. So this is the previous wave 4 low. It kind of starts at 697, and I would say the demand area is probably runs all the way down to 645. So 697, is that what I said? 697. Let me just put some numbers in here. That way we'll know what those ranges are. So this one, let me do this again because it's putting the number way over there, and I don't want the number way over there. So let's put it right there. And let's call that, let's say it starts there at, roughly 715 and ends right there at 641. So that means I'm looking at gold. So let me take that off. Take this big yellow box off, or maybe I just change the color. See, edit properties. Let's change this color to gray. Maybe that's a little less. Yeah. So what I'll do is I'll scoot this over some so we can see those numbers. So kind of that's where we're expecting to go, somewhere between the 715 and the 641. And it's you know, some people are like, there's no way gold's gonna. But look at how big this move is. I mean, I can't even really show all of it. Yeah, I'm on the max right now, but let's just measure it from here, which is about the low. That's near the low. So let's just take the Fibonacci tool and just go from roughly the very low to the very high. And what you'll see is that, you know, well, the 61.8 retracement, so it might not go this low, but the 61.8 retracement comes in here at 887. So I would at least expect it to go to 887. In fact, let's put that number in there just so we'll have it. Let's put that number right here. 887. What can I do? Can't really get on it there, but how about we just put it right there at 866, because there's a previous demand area there. So there, we got gold kind of labeled up there for us. So now let's zoom in a little bit, and we can see here, you know, we might just now be starting. So, you know, well, let me label it up some more. Sorry about doing all this labeling, but let's just say this is A. Okay, and this is B. Okay, and then C is going to be down here somewhere. This is probably 1. Number 1. So, you know, if this is 1, A, B, and we're looking for C to be down here somewhere, and you'll know because we'll have like a blow off. It'll probably last a week of just really like scared selling going into the bottom, and usually that kind of marks the end of a wave C. It usually is a little bit violent at the very end. In fact, that's a good way to notice one. All right, let's look at silver. You know, silver, I don't know. Silver still looks like it could go, like make one more high maybe, because it just doesn't look like it went high enough. Like to me, it looks like it's got to move above this high. And maybe gold has another high. You know, it's possible. Let me take this off. So I don't know. I'm still looking for silver maybe to go up into here. It's a risky trade because this could easily go up, make a lower low, and really rocket to the bottom. But, you know, if you keep a tight stop, you know, you might get some decent reward up in here, up into 21.5 or so. And but I'm not taking that trade. It just these commodities can really move quickly, and I don't want to be in front of that. All right, let's look at what else can we look at? Let's look at the euro US dollar. So again, I've been there's no secret that I've been nibbling at this and made a little bit of money and then missed. It's funny, you can't even see the move here. It's so slight, but if you zoom in a little bit and you look at like a 4-hour chart, this could be the move off the bottom. I'm waiting for a little bit of pullback to a higher low. So if it pulls back to a higher low, maybe somewhere in here, I'm going to start going long and start beating the euro up long as the dollar sells off. Now what's funny is I think people are going to be really happy about the dollar selling off, but I don't think there's anything positive about the dollar selling off. I think that's I think these finance guys like that because they think somehow that's going to improve exports. I mean, it does make our products cheaper, but at the same time, it makes us poorer here in the United States. So, and we're buying a lot of stuff from overseas. So I don't know how that's good for America, but that's what people seem to be excited about. All right, here's the British pound, US dollar. You can see it's already kind of made its move off the bottom, and I think is in the process of making some sort of retracement. You can see we already kind of pulled back to this one area, and maybe the retracement's over. It really doesn't look like it's over to me, and I'll tell you why. Because this doesn't look very ABC-ish. In fact, one of the ways you can kind of tell is if it stays inside of a channel. So, like if I whoops, let me draw a channel. So kind of this line right here. Well, I don't know. It stayed in the channel pretty well. So this could be A could be complete, okay. And then this could be B up, and then maybe we have a C down just below this low. Anyway, the British pound's probably going to be a good place to go long as well. At least that's the way it looks to me now. That can change, but that's the way it looks to me now. Let's see, the Canadian dollar, US dollar, Canadian dollar. I would look for the Canadian dollar to go all the way up into this area around this 1.343, and it looks to me like a retracement at this point. So let's put this in and kind of come down to here, and so somewhere in between here and 100, maybe it stops. We'll see. I don't know. To me, the picture is not as clear here, so I'm not trading it. The one benefit about the U.S. dollar, Canadian dollar, if you're trading pairs, is you got a positive interest rate here that the bank pays you. In other words, you're not having to pay money to stay in this for a long term. So if you think it's bullish, at least you're getting paid interest every day instead of paying interest every day. So maybe something to think about. All right. Let's just look at the. Let's look at. Sorry about this. All of a sudden, these things decided to come in on my YouTube deals. So sorry about that. Let's look at. What can we look at? We'll look at a big chart of the ES. Let me put in a weekly, and there's some interesting things when you go out further. there's things to see that you don't, normally see. One of the things that I've noticed is that we almost made a new, it's hard to, let's see if I can, kind of zoom in on this. You can see here, if I draw a line, if I put the cursor right over here above this high, you can see that down here, the internals, the larger degree trend was a high too. Then when I came over here to the next high, see how much lower the internals were? So you just didn't have the same strength at this second high. I mean, we were, I don't know, less than 1% from the high. I mean, we were right there. And then we sold off. So I think that's interesting. You can kind of see a similar picture on the daily. If you look at the daily, here's that previous high. I'm sorry. Well, it's not as clear here. I mean, see how close we were to that high? Now, what you can see here is here's the high, and you can see the trend was neutral. But then the time we made a second high, I'm sorry, when this is black, that means the larger degree trend was neutral. So we made a high, but the larger degree trend was neutral or sideways. But then we made a slightly lower high, and the larger degree trend had shifted to negative. So these are kind of internal measures that you just notice that are kind of helpful for seeing the larger picture on a market. Let's see if I've got another. You can see the 6E. You can see all around here. I bought right in here. I guess right here I bought right, but then I missed all this because I sold. So I mean, this is what happens in trading. You don't feel comfortable. I mean, part of the reason I don't feel comfortable is because I was kind of trying to pick a bottom, which is always dangerous. So you got to keep your stops tight. When you keep your stops tight, you get whipped around, you miss out. So you can see here, this is the bottom right here. So we've had this move up, and it's a pretty strong move up, and is likely. You can see this is kind of, the larger degree trend is neutral. It was no longer down, and you can kind of see a rounded bottom here, and you can kind of see a bottom rounding here. So, in all likelihood, the euro has kind of reached the bottom. It doesn't mean for sure it has, but certainly if it comes down here to a higher low and starts to move higher, pretty strong, then I would say the bottom might be in on the euro. But keep your stops tight. That's the key. The bond market. Let's look at the bond market real quickly. Which I don't have up here, so let me put it in here right now. I'm going to go to the ZB, and the thing about the bond market. Let me go to weekly. You can see the trend has been up forever, right? So we had a low, and then we had a high, and then a higher low, and then a high, and then a slightly lower high. See that? Lower than this, lower low, slightly lower than this low. So this should have been, in fact, this was my first alarm bell right here. And then when it did this, it made a lower high, right? This is lower than this high, and started to roll over. I thought, man, the bond market is probably topped. But then the question was, where does it, if you use Fibonacci, and by the way, if you don't know who Fibonacci is, just go Google him. He was an interesting guy, a really interesting guy, who lived back in, I think, the 11 or 1200s in a seaport. And anyway, he came up with the Fibonacci sequence, and it's an interesting sequence of numbers. If you take any number and you divide it by the previous number, you get a non-rational number. Non-rational number just means it's only when you divide it, it doesn't it's like pi. Pi is a non-rational number, 3.1415, blah, 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 you know, decimals go on forever. Same thing happens with the Fibonacci sequence. When you divide one number by the previous number, the division of those two numbers ends in a non-rational number. And so it's just a very unique number. And if you go read on it a little bit, it's kind of interesting because there's a lot of things that occur in nature that are at this 0.618%. So, for example, you can measure the height of your body, okay, and then measure from the ground to your belly button, and what you'll find is your belly button is about 0.618% of your total height. And these are just really strange things. The ratio between the last bone in your finger and the next bone is like 0.618. The ratio between your fingers and your tarsals in your hand is about 0.618. So you just have all these strange kind of relationships, and and it's not numerology or anything like that. It's just, it has to do with patterns and what our eyes are used to seeing. Branching in your arteries is a function of the Fibonacci sequence. Trees and root systems are branching in general is a function of Fibonacci type relationships. And so it's just interesting to go read about it. And what's interesting is a guy that lived back in, I think it was 1100 something or 1200 and something, somewhere back then, discovered this, without a calculator, without a computer. He was just a really good numbers guy. But anyway, so when we look at data, it tends to be like if we look at a sheet of paper that's gray, where the gray line begins and ends, we tend to favor it toward to one side. I know it's hard to explain. You just have to go read about it. But anyway, anytime you have a move down and you have an initial move up, you should be looking at this 0.618% because that's where things normally change. Now, you can see here we went down through it and then came back up through it. So we're kind of chopping around through here. And maybe it'll resolve itself higher and actually go here, or maybe it'll just roll over from here and go down. My guess is, if I was guessing, and you can zoom in on this. In fact, let's just do that. Let's zoom in. Let's look at an hourly chart. And an hourly is not going to be enough. So let's look at like let's look at a 5-minute chart just for the hell of it. So, it's hard to see here, whether there's a 5-wave move down there or not. There could be. This could be a 5-wave move, in which case we could have a wave 2 back into this area and then roll over. But as soon as we have a 5-wave move down in a degree of trend, I would say if we get 5 waves down to this area here, then this is clearly a wave. This whole pattern is clearly a wave 2, and the bond market's can roll, has rolled over, has done. The 38-year bull run in bonds, or whatever it is, 39-year bull run in bonds is over. So again, I've talked a lot about this on this program. Just be careful. It's, you can lose a lot of money in bonds. It's not like stocks where, it goes down 2% and you lose 2%. If it goes down 2%, you lose 15%. I mean, it's one of those deals. All right. That's about all I have this week. I'm starting to kind of ramble, so let me go ahead and get off, and we'll talk to you guys next week. Thanks a lot for coming in. We'll see you next week. Bye-bye.